Hello and welcome everyone back to an episode of the Playing Perspectives podcast. I'm one of your two hosts for today, Jamie Hopkins, joined by my co-host, Kate. Kate, great to see you.
Thanks, Jamie. Good to see you too.
And we're really excited today to be joined by one of our colleagues here, Mike Valenti, who's the tax director at Bryn Mawr Trust Advisors. Mike, super excited to have you on. You and I have gotten to know each other for a while over the last couple years and gotten to work together a number of times on some fun projects. And today we're going to talk about taxes, everybody's favorite topic. So excited to have you on, my friend.
Thanks for having me.
And it's definitely the right time, right? Like we're headed into tax season. Although for some people, tax season is a 12-month endeavor. For most people, right, this beginning of the year really is tax season up until April 15th. So we're going to hop into kind of what should people be thinking about, right? What are some things that people can do to prepare before filing, and maybe some takeaways for the do-it-yourselfers out there too.
That's great. So today we'll talk about the DIYers, and we'll also talk about those who have more complicated to very complex tax situations. And I'm just going to go ahead and say it. Taxes are stressful. It is an emotional event for a lot of people. Some people procrastinate. Some people are fearful if they're doing it themselves. Am I doing it right? They might be irritated or frustrated if they end up owing and they don't expect that. So Mike, help us help ourselves. What can we do to make tax time a little bit easier?
So I think one of the things is, first off, don't shoot the messenger. We love our clients. Unfortunately, sometimes we have bad news to share. But I think that's the crux of a lot of the issue you pointed out was we all dread the April timeframe because we're afraid of those surprises. We're afraid of what's going to come up. But with a little bit of planning that we can do throughout the year, and we'll talk more about this, is we can reduce that stress that comes in April. We can reduce the issue isn't necessarily how much we owe. The issue is worrying about how much we owe and whether or not we can pay that, because we don't know what it's going to be.
Yeah.
And as someone who a few years back, let's say their employer, not this one, messed up their withholding, and then I do my return last on April 15th at about 11 o'clock at night. I found out I owed $5,000 because I was busy working on everyone else's stuff. And so I unfortunately felt the same feeling that a lot of my clients have felt in the past. So I empathize. So one of the things that we can do is, especially if you can work with a preparer or even just do a little bit of planning yourself, whether it be setting aside taxes or making estimated payments throughout the year, it's just thinking about some things depending on your situation. How can we do a little bit of planning ahead? How can we know that we have to pay taxes. For most people, taxes are the largest expense. So doing a little bit of planning for that, we know we have to pay rent, we know we have to pay mortgage, we know we have to pay daycare, whatever it might be. Understanding that in your situation, whether you're a small business owner, maybe it's paying quarterly estimated payments. If you have a household with two high earners, oftentimes your withholding is not going to be enough. If you're in retirement and you're taking distributions, sometimes that 10% automatic withholding that your custodian recommends is not enough. So, we'll talk a little bit more as we get through this, but just keeping an eye on those things can be very helpful so that you don't have those surprises. And we can do a little bit of planning throughout the year and make April, my hope when I work with my clients is I can't say that you won't owe money, but at least you'll know that you'll owe money. Mm-hmm. And that removes the stress from that, and we can plan for it.
That's a really great point, because I think in either under withholding or over withholding, there are planning opportunities there. And so as we jump into the DIYers, the people who are doing it yourself, let's talk about what they look like. It's probably a single source of income.
Yep.
It's people who are W-2, so they have a salary, they have their taxes already being withheld. Maybe one person, a couple, they're using the standardized deduction and not itemizing. So it's pretty simple and not very time consuming, I'd imagine, from like a gather, organize, prep, and file your taxes. But what should be on these people's minds, and what does their checklist look like, and what are their planning opportunities?
Sure. So I think one thing we have to look at is a lot. We think about what happened recently, right? We just get our W-2, maybe we get some 1099s. Uh, you'd be surprised at how many people forget that they had a kid, or there was some big medical expense that occurred earlier on in the year. So it's like going back and thinking when they're asking you these questions, if you're using those sort of the big box DIY software, they'll give you a questionnaire, and it's a great questionnaire, but a lot of times people, they have a recency bias,
Mm.
and they forget about the things that happened, and even potentially before you did your last return, which was still the calendar year that we're talking about. So as you're going through, think about all of the major milestones. Think about when you bought your house. um Again, if there were any sort of, that's really what we see is earlier on in the year, people don't remember those things.
Mhm.
So it's going through trying to figure out, make sure that you don't forget those big things that happened earlier on in the year.
Yeah, when you start thinking about what happened back in January of 2025, you're like,
Right.
gee, I have no idea what happened in January of 2025 anymore. Like, was it January? Was it December of 24? Like, these are actually pretty long ago once we
And
get to April of
bonuses
26.
typically come out in February, right? So people forget that, oh, they switched employers, and now all of a sudden they're like, oh yeah, I did actually have a good chunk of money come through at that point in time. Or if you switch jobs and you forget that, oh yeah, well, it feels like I've been in this position for 10 months. There was this other role that I was doing. Or again, maybe you were getting healthcare through the marketplace for a few months. Like the number of times that I've had to resolve that, where they completely forgot that they had healthcare between jobs for a handful of months. It's just all of those little things that kind of go fall through the cracks because there was a change that wasn't exactly the most recent, but still in that tax year.
You
There's
mentioned one of the things I wanted to hop back on because I think this is one that does surprise people, which is much more common today than ever before, which is the two high income earning
Yeah.
spouses, and that they get the tax time every year
Yep.
and they're massively under withheld. Can you explain a little bit of like what's occurring there and maybe what people can do, especially for do it yourselfers? They're just like, why do I owe so many
Right.
taxes every year?
And it's amazing to me also that the number of people that come to me and say, I always owe tax every single year and I don't know why. It's like, well, let's start there. Um, so the way if you've heard of the marriage penalty, the way that tax brackets work is that the tax brackets aren't exactly, for a married couple, double what they are for a single individual. For most, if you're filing jointly. And so what happens is that the brackets are a little bit higher, but not that much higher. So if you have two people that are high earners, uh, you're going to get pushed in those higher brackets a lot more quickly than you would if you were just one person filing singly. So what I always recommend then is, we do tax projections for our clients. We map it out. We look at their pay stubs. We project everything out, and a lot of times we do really try to hone in and get we'll get it so you owe hopefully nothing come tax time. But if you're just doing it by yourself, the first thing I would start out with is just withhold married at the single rate, at the higher single rate. um, what I found is you start messing around with exemptions, you're going to end up owing. And so that's usually the first thing I do. Like, let's try withholding at the highest rate possible and then back it down once we see where you land at the end of the year.
And most employers, when you go through your payroll and benefits time period, right, it'll allow you to do an extra percentage in withholdings.
Correct. So especially like if let's say you switch jobs or you realize that, oh, midway through the year, a great example, right? So it's April, you do your return, you find out you owe $10,000 and you're like, I don't want to owe $10,000 anymore. So then we say, okay, maybe I owe $10,000. There's, I don't know, 20 pay periods remaining. Maybe we split that $10,000 into 20 and I bump up my withholding by $500 a pay period.
Yeah.
And so that's sort of a quick and dirty way to look at how we can try to hone in so we don't owe as much money in the spring. And then the other thing is if you have bonuses or if you're getting any sort of equity compensation, that supplemental income, if it's run outside your normal payroll process, is subject to the statutory withholding rate. And so for under $1 million, that statutory rate is 22%. And so if you're a high earner and you're earning, let's say your effective rate's like 30 or 35%, you could owe, there's a 10%, 15% shortfall between what's being withheld and what you're actually being taxed on. So you can very quickly, if a large portion of your compensation package is that annual bonus or those one-time events, you could owe hundreds of thousands of dollars in taxes pretty quickly and you don't realize it. And sometimes, especially if they're restricted shares, you didn't even get the cash. So, and ISOs, incentive stock options, are even worse. So those are areas where if you're a high earner and you have you have a big bonus amounts, you have these equity compensation pieces, you really want to have a finger on where your withholding's at.
So it sounds like we've moved from the DIYers potentially into the category where people should start thinking about having a team behind them or having a CPA or prepare. So talk to us a little bit about that. What are the markers? It sounds like you've talked about some of them here, because I don't know, maybe some people are doing this DIY, but you could miss some things if you're not working with a professional.
And what I found is working with a professional is generally better than not. And a lot of individuals, they could, right? In that example, if you have two, let's say executives, they're getting a couple W-2s, maybe they don't have much else. But what we found is just the way things are reported. If you have if you have income from multiple states, if you have equity compensation, it's very easy to misreport that. And so while paying $1,000 for a tax preparer might seem like a lot to you, think about this way. It's all right. So what happens if I get a notice from a state or the IRS and now I have to spend a couple hours trying to sort this out? What's my time worth trying to work through this? So it's not just paying the tax prep fee. It's also paying someone so that you don't have to worry about sorting through it down the road because you messed up. And it's very hard. And I don't mean that, like, not too many people are going to really recognize the fact that, like, stock options are not very well reported between the W-2 and the 1099. You're a business owner. Like I had a buddy of mine. He started driving for Uber and DoorDash, and so he was just trying to report it. Like the guy, was not making that much money, but he still messed up his Schedule C, and now we had to go amend it and fix everything. And it's like, just because let's say maybe you made $20,000 or $30,000, it doesn't seem like that much. But when Pennsylvania sends you a notice that, hey, you reported this incorrectly, now you got to figure out what you did and fix it. So it's oftentimes it's not necessarily just how much you make, but also if you have Schedule C, if you have rental properties. Again, certainly if you're a business owner or if you're employing people, you absolutely want to be working with a professional.
What are some of the mistakes that you're kind of expecting to see over the next couple years? Because we have been really on a kind of 6-year cycle, or I guess maybe 8 years if you go all the way back to Tax Cut and Job Act in 2017. But really kind of 2020 to now, we've really been on this kind of like constant tax change cycle. I mean, with extensions, what you can deduct changing, coming in and out, again, changes this summer that went retroactively into effect, which is almost unheard of, right? In the tax world, we almost always give people time to prepare, but we had a bill passed in the middle of the year that went back to the start of 2025.
I think one of the issues is the software is going to do the calculations generally correctly. There are some some issues where that doesn't necessarily happen, but generally the software is going to calculate that properly. The issue is now that there's so much that is being run through. Like the government has tasked the IRS with doing a tremendous amount of work, right? You think about when we had the stimulus payments. It was the IRS's job to track that.
Yeah.
It's the IRS's job to track healthcare premium credits. It's the IRS's job to track whether or not you over or underpaid FICA taxes, whether you're self-employed or if you're hired or split, jump from job to job. And so it's not just the income tax piece, it's the missing all of those ancillary pieces that we get into trouble. Like I can't hammer this home enough. The amount of people who are, receiving pretty much like the maximum ACA healthcare premium credits, like $20,000 because they're low income, who don't report it properly. Or there's a cliff, like let's say they go over that cliff. It was around $50,000 a few years back. And they all of a sudden get a job, or like they got a little bit of a raise, and it just puts them over the bump, and now it costs them $10,000.
Yeah.
So it's what we're seeing is just all of those little things that are being filtered through the tax return that get missed, and not necessarily oftentimes like the W-2, the tax on W-2s. It's easy. It's all those other things that we're seeing.
Yeah, and I mean, I saw one of the ones just at the end of the year, and I think anytime we get this mid-year change, it's really hard to do the right amount of planning around it.
Yeah.
But there was a tremendous amount of changes for charitable contributions, really starting in 2026.
Yes.
To the point where you're not going to see very many people, especially with an increased standard deduction and the AGI portion now for the below the line, right? Kind of.
Yep.
Higher donations counting for people. I just, I told a couple people the last 2 weeks of 2025, like, hey, if you're thinking about doing some of these smaller ones for 26, you should do them today in 25. And I think that was a big missed opportunity. But like, I think without working with a professional and understanding where your taxes kind of land, those ones, they change every year, every couple of years, and they just go missed. And I think that was a big one that I didn't hear talked about enough. If you weren't working with a professional.
Yeah, I think that when I was on calls with clients throughout the end of the year, it's funny because I feel like every year I'm hammering home donor advised funds.
Yeah.
just screaming at it. And it's always for different reasons. But the end of this year was because of the AGI threshold coming in. And then that was always my concern, was that when they were doing all of these cuts, they had to come from somewhere. And so people don't remember the P's limitations. And that was always one issue, was with higher earners, is the P's limitation came into play before the Tax Cuts and Jobs Act. So when they wanted to, part of the reason when they extended, when in the Tax Cuts and Jobs Act, a lot of these individual rules were not made permanent because they couldn't pay for them. And so I was waiting for that other shoe to drop. It's like, yes, we're going to extend all these things, but we got to pay for it somehow. And so how do we do that? Well, we kind of come in hard, like a lot on the charitable side. And I think with the rise of the standard deductions, with the new 0.5 AGI threshold that comes into play, and then also, again, there is sort of that pseudo P's replacement with how they reduce the itemized deduction at the top for, we're seeing that as you really want to plan and try to hit that sweet spot when you're contributing.
So, Mike, let's talk about some planning opportunities that we have with our clients. Those that are self-employed, we've got childcare credits or education credits. We've got the healthcare savings account or the FSA, itemizing deductions over standardized. So give us a little bit of planning opportunities.
Sure. For those who are self-employed, and maybe even this includes if you're doing some, like, say, consulting work on the side from your employer, a I always look at the easiest way to set aside some money for retirement is a SEP IRA. And that is effectively roughly 20% of your earnings you can stash away. Now the thing is, that's a rough calculation. You got to run that through the return. So best practice is set aside that money to contribute, and then when you do your tax return, you'll calculate what the actual deduction and deductible amount is, and then you can make that contribution. So calculate that amount when you do your return, make the contribution, and then file the return. Best order of operations. Because what happens is oftentimes we see people make, whether it be Roth IRA contributions or traditional IRA contributions, backdoor Roths, or SEP IRAs. What happens is they make it during the year, and then we go and do the return, and maybe they were over the limit, and now we have to unwind it. So that's like what I always recommend is set aside that money if you're going to do it, and then wait till we do the return, and then calculate exactly what that number is, make that contribution, and then file the return.
Okay.
So that's one way to try to avoid. A lot of us, we see it all the time with, say, like, hey, you made a Roth IRA contribution, great, I love it. You made too much money. So when we go through that, it's like I love people setting aside money, put it in a brokerage account or put it in a high yield savings account or something like that, and then figure out exactly what we can contribute and how much we can contribute. So that's one thing that I would always recommend for HSAs. HSAs are a fun topic. Remember, for as much as we talk about HSAs are only available for those who have a high deductible plan. So the first thing I say is, all right, so let's actually look at what your employer healthcare is. Does it make sense for you to have a high deductible plan and contribute to the HSA? Do you have a lot of medical issues in your family where having that additional insurance will actually be better for you, because we're looking at your net out-of-pocket costs? And I'll speak personally. Like, I don't have an HSA. I get, my wife's benefits are excellent, and it, because of a lot of the medical issues we have in the family, it actually makes more sense for us to have that additional coverage. And the thing is with the HSA is, the real benefit with the HSA is that if you can stash money in the HSA and then not use it for medical expenses, which doesn't make any sense to me. And then if you hold it long enough, then it just becomes another retirement account.
Right.
And they did change the rules where it's like, it used to be you had to hold on to the receipts. And then, like, when you're like, in order for this plan to work, you had to hold on to receipts. And then, like, when you were 70, you could pull it out tax free. They finally changed that. But I think that's what the HSA, there's a lot of talk about it. Everyone loves the triple tax advantage. I just don't know how practical that is for everyone. If someone's making $50,000 a year, are they going to be able to contribute, max out their HSA and then also pay out of pocket for your medical expenses? So when we talk about things like that, it's a great tool. I just want to make sure that, like, we can do this and leverage it properly. And so how we can look at it from the bigger thing. FSA, childcare FSAs. I'm going to do my last one, at least for now. Make my last reimbursement. Childcare FSAs are great. You can do up to $5,000. And that can be used for daycare expenses and a number of other sort of childcare related things. The issue that you run into with that is you have to be careful if you have a married couple, they have to both be working. A lot of times what we see is, like, you do the childcare FSA and one's not working or one doesn't have any earned income, and then it doesn't count. And they end up having to pay tax on that. But what that does is that allows you to pull pre-tax dollars and pay, reimburse or pay your childcare expenses pre-tax. And so, maybe you save $1,000 or $500 in taxes. I think one of the things to keep in mind is, as you're looking at all these tax saving tools, I think they can be great, but also look at the net actual savings. Like, if you're in the 5% bracket or 10% bracket, the one thing I always laugh at is, we love our teachers. They're the best. They're amazing. And we give them a $300 deduction, which after tax is like a $40 back in their pocket. What?
Yeah, you bring up a good point. Sometimes people hear the, deduction limits for things like, oh, that's pretty sizable, right? Like I could put $5,000 into an FSA. But again, if your effective tax rate is getting down there to the 10%
Right.
range, it's not helpful, but you're now talking about $500, not $5,000. And so then if you're only putting 2,500 in and you're a 10% effective rate, well, now you're talking about $250, which is still real money, but the whole going and setting it up, there's actually probably a $25 to $50 account fee in there too.
Right.
Now you're down to $200, and how much time. And actually, what you see with both with the FSAs, unfortunately, is people leave about $200 a year in them on average. I think it's like $178 or something last time I checked that people forfeit every year, which effectively is almost the entirety of the tax savings that people get from it. It's a very interesting thing.
Yeah, I did get the reminder from HR yelling at me saying that I still had some money. I was like, hey, relax, I'm submitting it this week. But that's true, and with the healthcare FSA, similar to the childcare FSA, it's a use it or lose it proposition, unlike the HSA.
Yeah.
So with these, you have a few months at the end of the year, generally speaking, to reimburse it and get all those clawbacks. But a lot of times what I see is people like, oh, we do this, we do this, we do this, but like sometimes it's a lot of work for very little return. And so that's why when we talk to clients, it's like, how can we do this in the most efficient way possible?
Yeah. And a big part of what you brought up is the higher income earning you are is typically where these things kick in. Like I've talked about it with HSAs a lot. I'm a big fan of them, but they tend to be for people who can afford it. I mean, that's the issue is like you have to be able to afford the out of pocket of your healthcare. You have to be able to afford to put $5,000 away and also not need it. I mean, it's actually 7,000 something now for a family, but you have to be able to afford to put that away and then not use it, because that's really where the benefit of an HSA is long-term investing, 20, 30 years of compounding tax-free. It is really powerful, but that's not for your average American. It tends to be for your higher income earners. And it does become kind of a supercharged Roth type savings vehicle.
And, I think with Roths are great. I love Roths. And, I think they're great. If I may jump, I think Roth, do I do traditional versus Roth? The conventional wisdom is that if you're lower income, or at least earlier on in your career, when you're looking at your career trajectory, you want to contribute to your Roth, say Roth 401k. And then as you get higher up and you start to reach sort of the pinnacle of your career and your higher earning years, you want to switch over to traditional. Why? Because you get the tax savings up front. You're at your highest rate. I have a bit of a counter take on that, where the thing I like most about Roths is that you have to pay the tax outside of your contributions.
Yeah.
Whereas, so when you pull money back out from your retirement distributions, where are you typically paying the taxes from? You're typically paying it from your 401k, your IRA distributions. So I do think that the Roth actually gives you an opportunity to, in theory, contribute more if you look at it from the sense of how you're paying the tax, because typically we assume we're paying the tax outside of the distributions. So I really think that when we talk about Roths and how we're doing it, is like, does it actually make more sense for someone, if you are a higher earner, to perhaps continue to go Roth?
Mm-hmm.
And then also, again, like, are you just going to convert this next year after you retire? I think there's a little bit more to it than it's a little bit more nuanced than just Roth early, then traditional, and then we go to Roth conversions, early retirement, and now we're pulling from that. So I think there's a little bit more thought that you can have between that.
Well, Mike, we have covered a ton of ground today, but that being said, we still get a lot of questions. Do we have time for a lightning round?
Yeah, let's do a quick lightning round.
Quick lightning round.
Which means like 5-10 seconds per answer.
Yeah.
Okay. I'll kick it off. Can you deduct your home office?
W-2 employee? No. If you're self-employed, generally, yes.
Okay.
All right. How about Venmo? What's happening with transactions there?
So all income to you as a business is taxable. That said, if you're paying your buddies to reimburse them for beer last night, that is not taxable.
Do you need to file a return?
Technically, no, if you don't owe tax. That said, I generally prefer to file a tax return to get that statute of limitations going.
So is it typically better to itemize or use the standard deduction?
Depends on your situation.
Should you file an extension?
I generally encourage it. It gives you and your tax professional more time to get everything together and prepare the return properly. I'd rather a properly prepared return that is correct than a rushed return that is incorrect.
What happens if you realize after filing that you messed something up on your taxes?
Amend it ASAP. We've all been there.
Do you need a CPA?
I would generally encourage it. I think more people need CPAs than use them. And like I said, there's anything outside of just your W-2, and even if you have a W-2, you probably need to talk to someone.
One other one we do get a lot too is crypto. Do you have to report your crypto transactions?
Yes.
Yeah, that was a big change, and there's some back end reporting now occurring too.
Crypto is crypto's got a few fun wrinkles, but generally speaking, outside of say like wash sales, if you think it's taxable, it pretty much is. Like, if it walks like a duck, quacks like a duck, it's a duck.
Yeah, there we go. So crypto the duck. That's good. It's well, thank you, Mike, for coming on, making taxes fun with us here today, or at least as fun as it can be when we're preparing. I love what you and the team are doing with our clients here at Bryn Mawr Trust Advisors, and doing tax planning throughout the year, helping people file. I know it's a super big benefit for those out there. Just to work with a trusted professional, get this off their plate, and have support there. Kate, great job as always on joining me. Yeah, and thank you everyone for taking some time out to listen to this episode of the Planning Perspectives podcast. Make sure you subscribe on your favorite platform so you never miss an episode. Until next time, stay safe and healthy, everyone.
Thank you for listening to the Planning Perspectives podcast. Don't forget to click the follow button to be notified when new episodes are available. Visit our website at www.bmt.com or call us at 833-973-7633. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Investments, not a deposit, not FDIC insured, not insured by any federal government agency, not guaranteed by the bank, may go down in value.